Welcome to the deep dive. Today, we're diving into a topic that really sparks a lot of debate: market timing.
hmm
You know, the whole idea of trying to buy low and sell high by predicting market swings. Wall Street tends to be pretty skeptical, right?
Oh, absolutely. Very skeptical. But our goal today, I think, is to see if there's actually something useful here for investors like you.
Right. Someone who, wants to grow their investments thoughtfully, but maybe without getting totally swamped by complex data.
Exactly. And we're mainly leaning on Leslie Masonson's book, All About Market Timing, from 2004 for this.
Okay.
It's got a foreword by Paul Merriman, actually, and acknowledges work from others in the field, like Nelson Freeberg and Cy Harding, key names.
Because really, at the end of the day, lots of us are in the same situation, aren't we? We want the growth the stock market can offer.
Uh-huh.
But those huge drops, those ups and downs, they can be, wow, pretty nerve-wracking.
Definitely. And Masonson points out there are kind of two main ways people deal with this. Either you shift more money into safer things, like bonds,
Right.
but that can limit your growth potential,
Right.
or you explore the strategy we're focusing on today, market timing.
And it's important. You mentioned the book's audience. It's not for, like, hyperactive day trader.
Not at all. No, it's
No.
really aimed at a more, let's say, conservative investor,
Mm,
someone who thinks about protecting their capital just as much as growing it.
got it. Okay, so let's jump in. The appeal of market timing. It's pretty obvious, isn't it? We've all felt that gut punch when the market just tanks. Think back to the early 2000s, 2000 to 2002.
Yeah, that was a rough patch.
Really rough. Only the second time in history the market had been down 3 years running.
Yeah.
You start wondering, is there a smarter way than just sitting there and taking it?
And that period really showed something crucial. Just because the market did well on average in the past, well, that doesn't mean it will keep doing that.
Right. Averages don't stop the bleeding in a crash.
Exactly. Those historical averages don't protect you from those big downturns.
And that's where Masonson makes a pretty bold claim. He argues that market timing, if you do it systematically, can actually be better than just buying and holding. His idea is it can potentially lower your risk and boost your returns by, sidestepping the worst drops.
Yeah, and he brings some evidence, or at least points to some. He mentions Timer Digest,
Okay.
which tracks how market timing newsletters perform. And during that same 2000-2002 bear market we were just talking about,
Yeah.
a significant number of those timers actually beat the S&P 500 and the NASDAQ. So the whole point is trying to cut your losses during those really bad times.
That makes sense. I mean, the NASDAQ got absolutely hammered then, didn't it? Down almost 78%.
78%. Imagine recovering from that. It takes ages.
Yeah.
And if you look back further, like the 1929 crash, that was even worse, like an 86% loss.
Wow.
Took over 25 years just to break even, not even counting dividends.
25 years.
Even a, quote, average bear market, say, down 33%, takes maybe 3.5 years to recover. That's still a huge financial hit and, emotionally draining too.
Oh, absolutely. Watching your savings evaporate, it's incredibly stressful. Masonson even talks about being at the New York Money Show in 2002 and how even the professional investors were all over the place about where the market was going, completely divided.
That's a really good point. If the experts can't agree,
Yeah.
then what hope does an individual investor have just blindly following one path? It really highlights why you, the investor, need to be informed and understand the strategy you're using.
Which naturally leads us to the big one, the classic buy and hold advice. It's practically gospel, isn't it?
It really is.
Yeah.
And Masonson notes that most people, something like 86% of equity investors, actually follow it.
And look, there are arguments for it. Critics of market timing often say it's just too difficult. You can't get it right consistently.
Right. You hear the famous Peter Lynch story, right?
But-
Saying he never met a market timer on the Forbes 400 list.
Yeah, I've heard that one.
And then there's the academic side, the efficient market hypothesis people who basically say stock prices are a random walk, so trying to time them is futile.
But Masonson pushes back a bit. He points out resources that actually track timers, like Timer Digest, Holbert Financial Digest. He even mentions RAFI, the Society for Asset Allocators and Fund Timers. So people are doing this professionally.
And a key concept here is risk-adjusted returns. This is important.
Okay.
Masonson suggests that some timing strategies, maybe like the best 6 months one we'll get to,
Yeah.
they might offer similar returns to buy and hold over the long haul, but with less volatility.
A smoother ride, potentially.
Exactly. Being in something safe, like a money market fund during the bad patches, that can really preserve your capital Yeah, feels better too, probably.
He shows some data in the book too, right? Comparing different stock bond mixes.
Yeah, Table 2.1, it lays out the historical returns and risks. Shows pretty clearly that, yeah, 100% stocks might give the highest potential return, but also the biggest swings. And he quotes Vern Hayden from Hayden Financial Group, who even back in 2002 was saying maybe pure buy and hold isn't the best strategy anymore, advocating for diversification, more active allocation.
That's interesting coming from an advisor. And Masonson's point about long, flat markets, these secular bears.
Yeah, during those periods, buy and hold really struggles. You're losing value, and inflation is eating away at what's left. Double whammy.
Okay, so if we're thinking about timing, what are the tools? What strategies are we actually talking about? Let's try not to get too bogged down in like super technical jargon.
Agreed. Keep it practical.
Oh.
Masonson mentions various methods. People use technical indicators, price, volume, sentiment, a lot of different approaches.
But the key thing he stresses is that successful timing needs to be like mechanical, emotionless.
Yes, exactly.
Yeah.
Systematic. You can't let fear or greed drive your decisions. That's a recipe for disaster.
Easier said than done sometimes.
Absolutely. But that's the ideal. And a core part of it is that old trading maxim. Cut your losses short, let your profits run.
Which is where things like stop-loss orders come in.
Precisely. They automatically trigger a sale if a price drops to a certain level.
Right.
Helps take the emotion out of it and limit the damage.
He also talks about sentiment and internal market indicators, kind of like taking the market's temperature.
That's a good way to put it. Gauging how optimistic or pessimistic investors are overall. Are they euphoric? Are they terrified?
And you check these regularly. Weekly, maybe?
Masonson suggests weekly, maybe even daily, during really volatile times. But he stresses, and this is important, wait for a clear signal that the trend might actually be reversing before you jump in or out. Don't just react to every little wiggle.
Okay, so let's look at specifics. Investor sentiment indicators. First one is the Investors Intelligence Advisory Sentiment Index, the Bull Bear Index.
Yeah, that's the one. It basically surveys a bunch of investment newsletter writers and advisors each week. Are they bullish, bearish, or expecting a correction?
And the idea is to use it as a contrary indicator.
Often, yes. When you see extreme readings like a huge percentage of advisors are bullish, it might suggest the market is getting a bit frothy, too optimistic, and maybe due for a pullback.
So peak optimism could actually be a warning sign.
It can be. And conversely, when almost everyone is incredibly bearish, super pessimistic, that might signal capitulation and potentially a good time to buy. You can find this data in places like Barron's or Investors Business Daily.
But it's not foolproof, right? He says it's more confirming than leading.
Exactly. Sentiment can stay extreme for a while before the market actually turns. So you need to see it start to shift, maybe alongside other signals, not just react to the high or low number itself.
Okay. Then there's the AAI, Bullish Investor Sentiment. That's about individual investors.
Right. The American Association of Individual Investors surveys its members about their outlook for the next 6 months. The book has a chart showing its history, tracking the percentage expecting a rise. Another sentiment gauge.
And then the famous VIX, the fear gauge.
Ah, yes, the VIX, CBOE Options Volatility Index. Sounds dramatic, but it's useful.
So what's it measuring?
It basically reflects what options traders are expecting in terms of S&P 500 volatility over the next 30 days. There's a similar one, the VXN, for the NASDAQ.
Okay.
Masonson focuses on the VIX. The key relationship is that it often moves inversely to the stock market. When the market drops sharply, fear spikes, and the VIX tends to go up.
And high readings might signal a bottom.
That's the theory. He notes that historically, when the VIX gets really high, he mentions a level around 49, it often coincides with periods of intense fear and market lows.
He gives examples, right, like 87, 98, 2001, 2002, where the VIX spiked, then came down as the market bottomed.
Exactly. The pattern he points out is often the market bottom occurs after the VIX hits its peak and starts to decline from those extreme levels. It's a potential signal that the panic might be subsiding.
Again, caveats apply.
Definitely. Masonson cautions that low VIX readings don't reliably predict market tops, and those really high spikes above 49 aren't super frequent. So it's another piece of the puzzle, not a magic bullet. It needs context with other indicators.
Makes sense. Okay, moving on from sentiment, moving averages. The 200-day and 50-day are the common ones.
Yep, those are the Viggies. They just smooth out the price action to show the underlying trend.
How so?
Well, the 200-day moving average, DMA, gives you the average closing price over the last 200 trading days. So it reflects the longer-term trend. The 50 DMA does the same over 50 days, showing the shorter-term trend.
Like looking at the forest versus the trees.
Kind of, yeah. Helps you see if the market is generally trending up or down, filtering out some of the daily noise.
And the signals come when the price crosses these lines.
That's one common use. Price crossing above the 200 DMA might be seen as bullish, crossing below as bearish. But Masonson emphasizes, again, it's not an automatic buy-sell trigger.
It needs confirmation.
Exactly. Use it with other indicators. A price crossing its moving average is just a potential signal that the trend might be changing.
Got it. He also briefly mentions the NYSE bullish percentage, NYSE.
Yeah, that one measures the percentage of stocks listed on the New York Stock Exchange that are currently on point and figure by signals. It's another way to gauge the breadth or internal strength of the market. Is the rally broad-based or just a few stocks carrying the load?
Interesting.
And finally, he talks about sort of combining these, assigning a score, maybe +1 for a bullish signal, -1 for bearish, across different indicators.
To get an overall market health reading.
Kind of like that, yeah. He shows an example table. A strongly positive total score might suggest conditions are favorable. A strongly negative score might mean it's time to be cautious. But it's just an illustrative concept, not a fixed system he's prescribing.
Okay, so we have some potential tools, some indicators. Now, what about the actual things you'd invest in, the investment vehicles for market timing?
Right. Masonson generally steers towards diversified funds rather than individual stocks for timing. He mentions index funds, sector funds, and exchange-traded funds, ETFs. He's a bit wary of actively managed funds because their fees can be higher.
Okay, index funds. Pretty straightforward. They just track an index like the S&P 500. Low cost, broad exposure.
Exactly. Basic building block.
Yeah.
Then you have sector funds. These zoom in on specific parts of the economy, tech, healthcare, energy, whatever.
Fidelity Select portfolios, gotta mention.
Yeah, he names them as a major player, notes they offer hourly pricing, which can be useful for timers, and even allow shorting some sectors, betting they'll go down.
But that sounds like it requires more specific knowledge, right?
Yeah.
Betting on sectors.
Definitely. More volatile, needs a clear strategy. He lists other fund families offering sector funds too. Vanguard, Invesco, Ridex, Pro Funds. Just be aware some might have redemption fees if you trade too frequently.
Good point. Then leveraged funds. Ridex comes up again.
Yes, pioneers in leverage and inverse funds. Leveraged funds use borrowing or derivatives to try and amplify the returns, maybe double of the index they track.
So 2x this S&P 500's daily move, for example.
Right, or the NASDAQ 100. And this is a big but, they amplify losses just as much. If the index goes down 1%, a 2x fund goes down 2%.
Ouch. So you really need to be right on the direction.
Yeah, absolutely. Masonson stresses these are for experienced traders who understand the risks.
Yeah.
Very high risk, high potential reward.
Okay. And finally, exchange-traded funds, ETFs. These are huge now.
They really are. Masonson explains them, well, they're index-based, like index funds, but they trade on stock exchanges all day long, just like individual stocks.
So you get intraday pricing.
Exactly. He mentions the originals, the SPDR or SPY for the S&P 500, diamonds for the Dow, cubes for the NASDAQ 100. Now there are thousands covering every imaginable sector, country, asset class.
What makes them good for timing, according to him?
Several things. That intraday liquidity is key. You can get in or out at the current price anytime the market's open. Traditional mutual funds only price once a day.
Right.
Also lower costs generally. Their expense ratios are often very low compared to active funds, and they offer diversification.
Still have sector risk with sector ETFs, though.
Of course, if you buy a tech ETF and tech tanks, you're feeling it. And standard ETFs aren't leveraged themselves, unlike some of those Ridex funds. If you want leverage with an ETF, you typically need to use margin in your brokerage account.
Okay, that clarifies the tools. Now, for the really interesting part, some actual illustrative market timing strategies. Let's focus on the main ideas here.
Definitely. First up is calendar-based investing, and the most famous example is the best 6-month strategy, or BSM.
The sell in May and go away idea, basically.
Kind of, but more structured. The core idea, backed by a surprising amount of historical data from various markets and time periods, is that the November to April period has historically outperformed the May to October period. Masonson mentions research suggesting this goes way back, maybe tied to agricultural cycles or even, bizarrely, European summer vacations impacting markets.
Interesting.
He shows S&P 500 monthly data, too. September, historically weak, other months stronger. The BSM strategy is super simple. Invest in stocks around November 1st, sell around April 30th, and just sit in cash or equivalents during the May-October period.
And the claim is better returns with less risk.
Better risk-adjusted returns is the main claim. You might not capture every bit of upside, but you potentially avoid the historically weaker, often more volatile 6 months. So potentially similar overall returns to buy and hold, but with maybe half the risk exposure. Plus, it's very low maintenance.
Who came up with this?
Masonson credits Yale Hirsch's Stock Trader's Almanac from 1986. He shares some dramatic stats from 1950 and 2001 on the Dow, showing a huge difference between investing only no vapor versus only May-Oct.
Wow.
He also mentions Cy Harding's enhancement, using the MCD indicator to potentially improve the timing of the entries and exits within that seasonal framework, claiming even better results.
And Masonson provides updated results comparing BSM, the worst 6 months, and buy and hold.
Yeah, through early 2003, using some backtesting software. The results presented in the book strongly favored the BSM approach on the Dow during that period.
Okay, what else? Cy Harding's strategy.
Right, the Street Smart Report seasonal timing strategy. As we just touched on, it builds on that seasonal tendency but doesn't use fixed dates. It uses technical indicators, specifically the MANCD, to identify potentially variable, favorable, and unfavorable periods each year.
So it's trying to be more adaptive than just the calendar.
Exactly, trying to pinpoint the start and end of the good season more precisely. Harding's research, cited by Masonson, claimed significant outperformance over buy and hold in both bull and bear markets. Masonson includes a table showing impressive back-tested results from 1964 to 2002.
Then there's presidential cycle investing. What's the gist there?
Just the idea that markets might exhibit patterns related to the U.S. four-year presidential election cycle. Certain years in the cycle tend to be stronger or weaker, historically.
Like the third year often being the best.
That's the common wisdom, yeah. Masonson presents average annual DJIA returns for pre-election, election, post-election, and midterm years. He also mentioned some specific strategies like Vacours that try to leverage this cycle and reported huge outperformance in backtests.
Interesting. If cyclical, what about moving average crossover strategies?
We touched on moving averages as indicators. Yeah. The strategies just formalize using their crossovers like the 50-day crossing above the 200-day as buy or sell signals.
But you mentioned whipsaws.
Yeah. The risk is in sideways, choppy markets. The averages can cross back and forth, generating lots of signals, maybe leading to small losses. But Masonson cites research by Robert Colby and Michael McDonald suggesting certain moving average combinations have shown positive back-tested results on major indices over long periods. Paul Merriman also apparently had success using a 100-day average on the NASDAQ 100.
And finally, the VL 4% and NASDAQ Composite 6% strategies. These sound very mechanical.
They are. They're examples of systems based purely on percentage price movements off a recent high or low. For instance, the VL 4% might signal a buy if the value line composite index rises 4% from a low, and a sell if it falls 4% from a high. Very rules-based.
And the back tests look promising.
According to the results Masonson presents, yes. They showed potential outperformance compared to buy and hold for the periods studied, suggesting purely mechanical systems can sometimes work.
Okay, this is a lot to digest. If someone listening wants to explore this more, where should they look? What resources does he recommend?
He lists several market timing newsletters. Timer Digest is a big one. It tracks the actual performance of top market timers.
So you can see who's actually doing well.
Exactly. The Holbert Financial Digest is another, known for calculating risk-adjusted performance. And Formula Research, which focuses more on developing and testing timing models.
Any websites?
Yeah, he lists a few from the time, like Hayes Market Focus, Paul Merriman's fundadvice.com, decisionpoint.com from Carl Swenlin, and a service tracking Bob Brinker. Obviously, some of these might have changed since 2004, but it gives you an idea of the kind of resources available.
And if you wanted to hire someone.
He mentions the Money Research newsletter and Select Advisors as services that, at the time, helped connect investors with advisors using timing strategies, particularly with RightX funds.
And software.
Briefly mentions Ultiari Financial Systems and TradeStation as examples of software for analysis and backtesting your own ideas.
Well, we've definitely gone deep into market timing today. It really seems like while Wall Street often dismisses it, Masonson builds a case that it's at least a potential alternative to just buying and holding forever, especially if you're someone who really wants to actively manage risk.
Yeah, and it's worth repeating. Everything we've covered comes straight from the source material you gave us. We've tried to just distill the key arguments and evidence presented in Mason's book.
So, maybe a final thought for you to consider. The simplicity of buy and hold is appealing, no doubt. But could understanding market cycles, maybe using even some basic timing strategies, lead to a more informed, maybe even a less stressful path to your financial goals.
That's something to think about. Consider the evidence we've talked through. Maybe check out some of those resources if you're curious, and see if any of these ideas resonate with your own tolerance for risk and how you want to approach investing.